Hello and welcome to episode 501 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leakes. Slightly strange intro to this podcast because while I often make mistakes and have to re-record the podcast intro, I'm re-recording this podcast intro for a very different reason. Damien, do you want to explain?
So, for everybody out there, obviously we've had the trade war that's been rumbling on, and since we made our last podcast, that's podcast 500, then Donald Trump in America announced the reciprocal tariffs, and the whole world was shaken by this particular investment market. So what we did was record a podcast explaining everything that had gone on, what could happen, the impact on markets and things to look out for, and the impact on personal finances. So we did that on Wednesday, and Andy and I finished the podcast, and it was funny because I was walking home after recording in our studio, and I happened to flick up the stock market app on my phone, as I often do, and I could see that the US stock market was up at that point by about 7%. And I'm like, yeah, something's happened. And inevitably I thought, oh, it must be something to do with the trade war. So long story short, Donald Trump, minutes really after we finished recording, announced that he was putting a delay on the reciprocal tariffs worldwide, excluding China, but the 10% tariff was going to remain. Now, if that doesn't mean anything to you, then you're going to listen to the podcast in a second that will explain more about it. So Andy and I were talking, and like, well, have we just recorded this great podcast and it's all for nothing? But what's actually transpired since is that rather than can that podcast, because there was a lot of gold in it, and we talked about a lot of things you're going to learn about economics, markets, things to look out for, as I've mentioned, things have started or continued to change and actually escalate, because the trade war between China and America is escalating. As we make this, I think we're up to about 125% tariffs from each other on, I think America have actually gone to 145%. So the pause that we got in the trade war is only temporary, apparently. Not much detail how that's actually going to work, so for 90 days, but the baseline tariffs are still there. And the market rally has started to unwind. And I also mentioned something about bond markets in particular in the podcast, which you are going to now listen to. So what you've got to imagine is that this podcast, when this was made, was just before the tariff pause was announced, but everything in it is still very relevant. And what we're going to do is come back after this episode is finished and then give you an update and to point out a few things you need to bear in mind going forward. So Andy, with that context given, we're going to play the podcast. There's a lot of value. So all we talk about is still very much relevant, but then we're going to provide a little bit of an update at the end to give that wider context.
Okay, let's cut to us in the past just a few days ago, and we'll come back after the podcast, like you say, Damien, and we'll summarise and talk about what it means going forward. So here we go.
So what we're going to do is do a special talking about the tariffs, explaining what they are, how they've come about, the flawed thinking behind them, but then looking at investment markets, talking about some things you might not actually be noticing. Everyone focuses on the stock market, but there are some other areas you might want to be looking at. And then I'm going to do a piece on how it's going to impact your finances as well. So for people in the UK, even though the tariff trade war does feel like something that's going on, particularly between the US and China, there are going to be some implications for us in the UK. And it may be a case that people might want to start preparing for that. So I'm going to explain that later in the show.
Okay, so it's been a couple of crazy months, as we know, since Trump has come into power, but this last week especially has been particularly crazy. What exactly has been going on?
So, as you mentioned, Trump has been in power now for a few months, and there was already some trade tariffs being imposed or talked about by Donald Trump, and he was imposing them particularly on Mexico, Canada, and China. And then we got to the end of March, and Trump was talking about the Liberation Day, as he called it. So that was the 2nd of April, where he was going to impose reciprocal tariffs. So reciprocal tariffs are, well, as Trump defines them, this isn't as everybody else defines them, but Trump has deemed them to be tariffs that compensate for trade barriers and regulation, as well as tariffs that exist from other countries. Now, what that means is he's effectively created a trade tariff on any imports into the US based upon some kind of calculation that him and his team have come up with. So the way they actually were calculated was far simpler than they tried to make out. The trade deficit for the US in goods with a particular country was calculated, and then it was divided by the total goods imported from that country, then divided by the number 2. So if we take the EU, for example, they calculated that the US imports 235 billion pounds worth of goods more than the EU takes from the US, and the total imports from the EU is $605 billion. So what they did is they took that first number, divided by the second number, which gives you 0.388, which if you round is 39%, and they divide that by 2 and come up with 20%. And there you go. That's the tariff that's been imposed on imports from the EU into the US. Now, the UK got off lightly. There was a 10% tariff. So what Trump did was create a baseline tariff that he imposed on the whole world, which was 10%, and then additional tariffs on top of that for individual countries based on this peculiar formula that I just described. Now, it did mean that there was an island near Antarctica that's just got penguins on it and nothing else that actually has a 10% baseline tariff, which shows you how ludicrous the whole thing is. And the idea is, as Trump claims, that the tariffs will cause countries that export more to the US than they import from the US to actually bridge that gap and start to import more from the US. Now, that is a very bizarre way of thinking, because it's a bit like me going to Starbucks, for example, and then buying a coffee for £3 and then saying, well, I've now got a trade deficit with Starbucks, so I'm buying stuff from them and then therefore not buying stuff from me, and I'm going to impose a 50% tax now on anything that I buy from Starbucks. Then when next time I go to Starbucks, I'll pay £4.50 for my coffee and it won't make any difference to Starbucks. That is, in effect, what trade tariffs do. And Trump is trying to claim that that's not how they work and the people in the US don't actually pay the tariffs. The truth is they do. Now, there can be a case where they might not, because if you were a company and you were exporting goods to the US and therefore your goods overnight have become more expensive because of these trade tariffs, then you might have customers in the US who will therefore not want to buy your goods and choose something that may be made elsewhere, in particular from the US. And therefore your sales might start to drop and you might decide to cut your prices and let that eat into your profit margin. So therefore the price of your goods for a US consumer in the shops doesn't go up by as much as the actual tariff that they've imposed on the goods when they're imported. Now, that does depend on your profit margin. So these tariffs of 20%, 40%, or in the case of China, as I make this podcast, they've got to 105%. Those margins aren't going to exist. So it does mean that people are likely not to buy those products in the first place, or if they do, they're suddenly going to leap in price. Now, that is going to be interesting. How does that play out for US consumers? Tariffs are therefore inflationary, and given that that's something that the US Federal Reserve, which is the equivalent of the Bank of England, is worried about, well, will they have to start to increase rates to bring that under control? Well, the other thing you've got to worry about is that it could start to impact economic growth, because it's not just about goods that are imported, it's about parts, for example. So cars are made from parts imported from all over the world, and the global economy has moved to this just-in-time way of working, so things end up where they need to be at the right time, and that reduces costs and that increases companies' profitability and the ability to make products from different parts all over the world. Well, that supply chain is now being shattered by these trade tariffs, and that will therefore cause problems for car manufacturers globally, but also in the US. So take Tesla, for example. They import lots of parts from outside of the US if they're going to assemble them in the US, because lots of cars now have electronic components. In fact, it makes up about half of the components in a car now. Go back a couple of decades, then electronics weren't the largest components of a lot of cars. It was just basically rubber and metal. So that's going to have an impact, and it's one of the reasons why you've seen Tesla's share price continue to slump, but also why you've now seen Elon Musk start to make grumblings about tariffs in the press. So we are in this scenario now where we are going to have tariffs for things that are going to be imported into the US, which is going to be bad for the US economy, but also for consumers, because if consumers are going to probably stop spending in the shops, that will hurt consumer sentiment. Also, businesses, when other countries start to retaliate, which China has now done. In fact, as I'm making this podcast, I'm just reading they've now increased their tariffs to 84%. So it means that exporters from the US are going to start to be hurt as well. So that's going to impact economic growth, not just in the US, but also globally. Now, the other thing just to point out about the tariffs is that if you increase tariffs on imports into your country, it can also cause your currency to increase in value. Now, that's not something that Donald Trump actually wants. He wants the currency to devalue slightly because that will increase the competitiveness and attractiveness of US exports. But what happens is if the imports are increased in value, that means that people stop buying things from abroad. So if you think about it, if somebody is buying something from abroad, then they are effectively selling US dollars to buy something in a foreign currency. Now, what that does is remove a downward pressure on the dollar, and therefore your currency can start to strengthen. If your currency starts to strengthen, so the dollar starts to go up, then that makes your exports more expensive to foreign consumers. So inadvertently, by trying to put tariffs on imports into the US, Donald Trump could make the exports less competitive as well. So that's going to have another impact on their economy. Now, the other thing I just want to point out about the calculation I mentioned earlier is that it's being dressed up as a tax on countries because they are deliberately choosing not to necessarily buy from the US and they're exporting more to the US than they're importing. But in reality, there are countries that don't import a lot from the US because they can't afford to, and they might export some goods to the US. So therefore, the difference in trade can seem significant. So there is a deficit from the US's viewpoint, but that's because of inequality in terms of wealth of a country. Now, Bangladesh is an example of this. So what you're doing is effectively taxing or penalizing a country's imports because of a difference in wealth. Now, that is, in a way, ludicrous.
So yeah, on that, Damien, so you've mentioned quite a lot there about how ludicrous this whole situation is. I mean, is there anybody in the US particularly, because I'll be interested to hear their viewpoint, who thinks this is a good idea?
Generally, real die-hard Trump supporters seem to still think it's a good idea, but nobody who seems to be an economist does think this is in any way going to work out. And we have had tariffs like this in the past. It's 100 years, in fact, since there are tariffs like this, of this size and magnitude, imposed by the US, but it was a different world back then. So there's hardly anybody alive who's seen something like that. So it just shows you how historic what we've seen is. But the idea of tariffs trying to penalize countries and make companies decide to make things in the US to avoid tariffs, to therefore protect their share of the US market when they sell their goods, seems very flawed. Now, to give you an example, if you are a car manufacturer, let's say you are an Asian car manufacturer, so maybe Kia from South Korea, for example, to be able to build a plant in the US to start making car parts would probably take at least 5 years to implement. And then when it comes to actually building the logistics and the regulation, everything around making that work, it would probably take a decade. So that would cost billions and billions of dollars to probably produce and start that whole process. But it's on a gamble that that's going to be the right thing to do in the next 5 to 10 years and policies don't change. Because you've got to remember, what we're seeing now is there's been lots of comparisons to the impact on global growth and the stock market compared to the pandemic. So that's the last time we've seen such seismic moves and such concern. But you've got to realise that was a disease we didn't know a lot about that was shutting down the whole world. This has been caused by one man's ego and determination to impose his will on the world and to change the world order. Now, to change the way the world works in terms of economics and the way logistics work, for example, and the way trade works, and to try and do that within days and at speed is going to cause a complete car crash. So that is what we're seeing at the moment. But that's why there's been these knee-jerk reactions that we've seen in stock markets in recent days, where there's been rumors that Trump was going to put a 90-day pause on the tariffs, and then it saw the biggest swing, so the intraday moves up and then down again when the rumor was proved to be false. The market rallied about 6% in minutes, and then later in the day then collapsed when the rumors were, as I said, proved false. So it just shows you the knee-jerk reaction to how twitchy markets are, because it all depends on what Donald Trump decides to do. Now, there are people who suggest that he's going to use it as a bargaining chip and will have to back down, but we are seeing things happen that Donald Trump didn't expect. So I'm going to move on to like the stock market, for example. So if I look at the stock market returns since the tariffs were announced, then what we've got is the Nasdaq 100 is down around about, as I look at this, about 12 to 13%. It's one of the worst performing stock markets in the world. The Hang Seng, which is the Hong Kong stock market, is down a similar amount. But if you look at the Japanese stock market, it's down 8%. The FTSE's down around about 8%. The German DAX is down around 9.5%. So we're talking about massive moves. We're seeing moves that haven't been seen since the pandemic, and moves that are on a par with what we saw in the financial crisis. There's even moves in things like the VIX, which is the fear index in the US. That has closed above 40 for 3 days in a row. All you need to know is that that is an extreme measure of fear. It hasn't done that since the pandemic and 2008. So that shows you the scale of some of these declines. In Asia, the declines that we saw were the largest since back in the late 1980s. And actually, going back to the beginning part of this week, on Monday, there were headlines already being written about us witnessing another Black Monday this week. As it turned out, it turned around, but we are still seeing the S&P 500, for example, go into bear market territory, which means it's down 20% from its recent highs. We're seeing similar moves, corrections of 10% from recent highs in stock markets globally. Pretty much no matter what stock market you are in, you are seeing heavy losses, which is actually starting to cause a lot of people in the US to complain, because their 401ks are now down. They're seeing their wealth decline. Of course, we've got the threat of inflation as well.
Talking about these numbers across all the stock markets across the world, has the damage been done? Is it permanent? Let's say that decisions are made and maybe Trump does change his mind. How likely are things to fully rebound, or is that damage already been done?
Well, it's a good question, and there are lots of different analysts who have views on this. And I think a lot of people believe that even if Trump reversed course, which is unlikely he would do at the same pace, the damage has been done in terms of the relation with trading partners. Now, tariffs don't tend to be removed as quickly as they are put on if you look at recent history. So the damage is already being done. And even if they are removed, it's probably not going to mean we're going back to a world that we had before April the 2nd. And there are some analysts who are claiming that the world has fundamentally changed. That's why what we're seeing is so important. And it is also a reason why, even though we've seen a short-term low in the stock market and the last day or so has seen a little bit of stability, that is why we could see the market still go lower from here. Now, that's not a prediction I'm saying is going to happen, but we've seen a seismic move. But if the world has fundamentally changed and the US stock market, for example, is now seen as a slightly risky bet, then that does mean that we might start seeing investors shifting their capital elsewhere, because there will be trade barriers that exist that didn't before, and that's going to have a huge impact on companies' profitabilities and therefore share prices. So until things change, we are in uncharted territory.
We've seen slightly similar things here in the UK. I say slightly similar because let's talk about Truss. Crazy things happened with Truss and very quickly she fell on her sword. How likely is it for Trump to do something similar? I'm assuming not very likely at all.
Well, I mean, I can't really answer that, but yes, it's a good question because it is a Liz Truss style moment. The difference is that Donald Trump is playing golf when the markets are collapsing and where it seems his economy is also under pressure. And one thing that's quite interesting is the bond market. So I've mentioned the stock market, and you can look at your stock market apps to see the complete carnage that's been going on. Now, bond markets have also been showing signs of stress. And I'm talking particularly about the Treasury market. So the US Treasuries are seen as a haven asset. So they are almost the foundations of financial markets. But what we've seen, a yield spiking and pushing higher. Now you would think that as stock markets have been collapsing, bond yields would fall as people buy bonds. So in particular, Treasuries in this instance. And we've not seen that. In fact, as I mentioned, yields have been pushing higher. Now, also, on top of that, you've got to bake in the fact that recession is now increasingly likely in the US and globally. So I've seen predictions now by leading investment banks that have put the odds of a US recession this year to 60%. So it's actually the most likely outcome based on their predictions. So that is being caused by Trump's decisions on tariffs directly. If we get a recession, that tends to make bonds and treasuries more attractive. So again, you'd think people would be buying them and yields would be falling. What we're seeing is the opposite, as I've said. Now, one of the reasons people are speculating that we're seeing this rise in yields is because big hedge funds are unwinding bets on treasury. So what they tend to do in a normal functioning market is make money from the difference between the price of treasuries and the future contracts on treasury. So this is like an arbitrage, and they use lots of leverage, borrowed money, to make these large amounts of money, but basically on small trades effectively. So small differentials, but when you put huge amounts of money behind it, that can make a lot of money for these hedge funds. But as yields have been rallying, they've unwound these bets at scale, which therefore means they've been selling them, which therefore puts pressure on yields. It means yields go up. So that is a cause of concern for the US, because if you remember, and it's a very good point you bringing up Liz Truss, we saw gilt yields spike back then, and that caused mortgage rates to push up at that point in time, and we've had higher mortgage rates ever since. With Treasury yield, so that's the Treasury is the equivalent of the UK gilt, but in the US, if Treasury yields are spiking, which they are at the moment, that means mortgage rates are likely to start going up in the US. And of course, that also means if interest rates generally are going up in the economy, then the Fed is going to struggle to cut interest rates if the economy is weak. They're also worried about inflation. So the Fed in the US is caught between a rock and a hard place. And one of the best analogies I heard is it's a bit like you're having two children in an airport that run off in different directions, and one of them is inflation and one of them is economic growth. You're worried of which one you're going to go after. You're going to cut rates for economic growth, or you're going to raise them for inflation. So you are caught in a almost impossible position. So that's why it'd be interesting to see what the Fed does in upcoming meetings. There is speculation they may have to step into the bond market in the US to stop Treasury yields spiking ever higher. So it is interesting that we've got a situation now that I don't think Donald Trump banked upon. In fact, he was hoping yields would fall, because that would mean for the US that he could probably borrow more money at lower rates, and the rates they'd have to pay on treasuries would also reduce. So if in effect, it would be the equivalent of reducing the interest rates on the debt that the US has. That doesn't seem to be happening. In fact, what we're seeing at the moment is a lot of the pain is being felt by the US initially. And so people are becoming a bit averse to US debt, so treasuries and US stocks. So how that pans out in the coming weeks and months is very difficult to say. And of course, where does that leave you for your position in a portfolio? Do you start to bail out? Well, it's an individual choice. But it's very hard to predict what will happen, because it's likely that governments are going to intervene. I'm not just talking about possible negotiations, but I'm talking about fiscal stimulus. Or you could have central banks starting to intervene in markets. We've already seen it in other countries. We've seen interest rates cut in India, for example. We've seen central banks in certain parts of Asia step in to prop up stock markets. So that is very hard to build into your thinking. So this is very reminiscent of the collapse in bond and equity markets during COVID. And we also saw something similar in 2022, where sometimes if you make a knee-jerk reaction, it's possibly the wrong thing to do if we start to get a recovery. So it is an interesting period that we're in, unprecedented to a certain extent, but as I've already mentioned, a lot of it has to do with Donald Trump and his ego, and maybe this could all blow over in the next couple of weeks, but it does feel a little bit unlikely.
One of the interesting points about this coming, and really on the timing of it, is here in the UK, because of course we have ISA season, we have tax year end. It kind of fell at the worst time for the UK. Not that Donald Trump cares about all of this, but what would be your sort of take on it for UK investors and the timing of all this?
So I think for UK investors, I do think we saw a reticence from people in the UK to invest in typically would be the busiest period for investment, which was the end of the tax year. So at Money to the Masses, we see a lot of consumer behavior that tells us what consumers are doing. We can tell that from what they're looking at, reading, and with the partnerships that we have with different companies in the investment world. We could see that there was a greater reluctance of people to invest. Now, I'm not saying that when the market was falling, there was nothing going on. There were people who were clearly also wading into the market because they were looking for a bargain, because we've seen some spectacular falls, which does obviously represent a buying opportunity. It doesn't mean markets can't fall further, but they are a hell of a lot cheaper than they were just a week or so ago. So that does present an opportunity if you are a long-term investor. So yeah, you're right. We did see some changes in behaviour, and I think it is impacting investor sentiment in the UK. And I think there was a big surge for cash ISAs, but that was also partly because you could still get decent rates on cash ISAs. I mean, they were variable rates, but you were still looking at above 5%, so that did impact it. But from a UK consumer perspective, which is where I want to shift on to now, I do think there's going to be some significant impacts for us and our personal finances. So a big one is, are we going to get a recession? Well, the odds have increased for us because of the tariffs. But the thing is, we actually buy more from America than we export to it. In fact, we shouldn't have had a tariff at all if the formula that he used to create the tariff model and the rates he imposed on everybody, we UK shouldn't have had one, but we nonetheless got the blanket 10%. So in some ways we got off lightly, and maybe negotiations could eventually remove that. And maybe that's part of the reason why we've seen the UK stock market behave or slightly outperform some of its peers globally. It has been hit hard, but it has slightly outperformed, even though they've all fallen almost in tandem. But the odds of a recession have increased. And in fact, the bets, if you look at the markets of where interest rates, I'm talking about the base rate here, from the Bank of England will be over the next year, they have fallen. So prior to Trump's tariffs, the market was betting that the Bank of England base rate, which is currently at 4.5%, would be at around 4% at the end of this year, so the end of 2025. Now, after the tariffs, the market is predicting that the base rate will be at 3.75% by the end of the year. So one extra rate cut. Now that could feed through to the mortgage market. And there's been headlines stating we're going to see a price war in mortgages in the next couple of days. It's going to launch and we're going to see loads of cheaper rates. Now, I did a piece on social media about this, and I think people are getting slightly ahead of themselves. Now, the market is predicting that the base rate will be lower than it previously thought at the end of the year, and that could feed into mortgage rates. But you've got to also realise, I mentioned earlier, that yes, treasury yields have been increasing, but it's fed through to gilt yields too. So if gilt yields start to rise, and we mentioned Liz Truss before and what happened after her infamous mini budget, if gilt yields rise, that does have an impact on UK mortgages. So there are more factors than just the base rate that come into play which dictate mortgage rates. So I would argue that we're in a position where mortgage rates could well start to fall a little bit quicker than they had been predicted to fall. But I think the falls in the near term are going to be on the short-term rate, so 2-year fixes, maybe by about 0.25% lower than they would have been, say, a week or so ago. We might see a bit of a little price war around that area. But if you look at the predictions for where the base rate will be in 5 years' time, it's still predicted to be at 4%. That hasn't changed. And that's because I think the market is still worried about inflation being sticky. And of course, if we have tariffs and we have inflation globally, that could feed into the UK as well. So I think the Bank of England is also stuck in a very difficult position. And we are probably going to see mortgage rates come down a bit, but I wouldn't bank on them tumbling unless we see a full-blown crisis. And there are analysts out there that are predicting that this could escalate into a full-blown financial crisis starting in the US if there isn't some kind of intervention from, well, obviously Donald Trump, but central banks themselves. So that is one thing to think about. The other thing is, in terms of the economy, there is a scenario, yes, we could start seeing prices increase because of tariffs globally. So we have a full-blown trade war, but it very much depends on how the UK positions itself because we're no longer in the EU. The one thing I would say is that where you've got countries like China, for example, who now may not be able to export as much to the US, there are going to be products that they're going to have to dump on other countries, other economies to try and sell. So it's a bit like if you had a business and your biggest customer decides not to buy from you, you've made lots of stuff and you've got to try and sell them to other customers and you'll have to therefore sell them at a cheaper rate. So what that might mean is that it will start to push some prices down on products that start to make their way here from China that would have probably been sold in countries like the US. And that can be bad news actually for the UK because as a consumer you might think there's some cheap products, but if you are somebody who makes things and sells them in the UK, so a manufacturer, that could then start to undermine your business model and could make it fail. So that could start to mean we see unemployment figures start to rise in the manufacturing industries. I mean, the car manufacturing industry is already going to be under pressure anyway from the tariffs. I've seen quotes suggesting that you could see 20,000 people maybe made redundant because car manufacturing could be hit. It is bad news for the UK economy. That is something that we've got to bear in mind. So like any period of uncertainty, like COVID, I think buffers in terms of cash buffers are important. If you don't have one, start to build it. 3 to 6 months of expenses or salary, whichever you prefer to use, to help in the case that you might lose your job or your business might struggle, for example. So I think that is something important to think about, but also in terms of expenditure that you're going to be making, you might want to batten down the hatches slightly. I do feel like I'm being slightly negative, but I'm just being realistic with people. This is incredibly uncertain and nobody can predict how this will pan out. But the one thing that we can be sure of is that it isn't going to be, the world's not going to be like it was 2 weeks ago unless Trump changes course. So making financial decisions based upon that is probably slightly risky.
So you've talked here for the last half an hour or so, pretty much doom and gloom across the board because of what Trump's up to, and markets are down pretty much across the board. Where are the haven assets? Where is the money running to at the moment?
So gold is one of them. Gold was already at all-time highs. And the thing is that we had gold, interestingly, drop a little bit in recent days. And I think part of that was because of those hedge funds starting to liquidate almost anything in a panic because they were trying to unwind trade. So that did hit gold. And also we saw the dollar strengthen, which tends to be negative for gold. But gold has been the asset that has rallied during this period, and it is often seen as a haven. So typically you'd also think that maybe gilts would be a haven asset. We've not seen that because of this unusual period that we're experiencing in recent days where yields are going higher. And one of the things I didn't mention actually earlier, hedge funds are apparently one source of the increase in treasury yields. The other could be China itself. So China is the second largest holder of US treasuries. So if you wanted to hurt the US and you were China, if you sold those treasuries, that would push the yields up, and that would therefore start to impact the economy in the US. And there are people suggesting that they are doing that, but given that you hold those treasuries, it's kind of an element of self-harm, if that makes sense, because if you sell them, then you're putting downward pressure on those treasuries, which are the assets that you still hold as well. So I think we are seeing some of that, which is causing the slightly odd movements in bond markets, the high correlation with equities at the moment. So cash is the other obvious place that people are going to, but we're not seeing it necessarily en masse, but there will be people who are pulling out of the market for sure.
On the question on China holding a lot of those US treasuries, is that normal to have an insurance policy like that? Do other countries do that?
Yeah, central banks do tend to hold them. And one of the reasons is if you trade with other currencies, you therefore need their currency to be able to make those trades. And therefore, if you have lots of dollars, what do you do with them? Well, the easiest thing to do is buy a US Treasury because you get a return on that Treasury from the coupon, so you can make money as well. So it is usual for central banks to have large amounts of US Treasuries, and the amount that China actually has is, I think, something to be speculated about, because I think they also hold them in Europe as well, but they're not necessarily associated with China. So it is difficult to say. Some people are claiming that China will continue to dump them and weaken their own currency as a retaliation, because if their exports are becoming more expensive for US consumers, if you make your currency weaker, it increases the attractiveness of the things that you are trying to export. But again, that's a dangerous game. If you start playing that, then there are other possibilities that could happen that you might not want if you are China. So it is interesting. We are in a period now where there are so many moving parts. And I would say to people is, do look at stock markets, and not necessarily your portfolio. Do read the headlines and the economic outlooks and the analysis that you see, because in periods of high strain and uncertainty, you get such extreme movements in markets, whether it's gold, whether it's crypto, whether it's stock markets or bond markets, that you start to learn very quickly about the usual relationships and unusual relationships between assets. And it's then that you probably learn more about investing and markets and economics than you do in a period of absolute calm. So I hope that I've given some context to what's going on in the world at the moment. And I can't predict what's going to happen. I don't know what's going to happen. It's anybody's guess. But hopefully you've gained a bit of insight and some interest into things that are happening that you might explore yourself. As I mentioned, it's a great time to learn.
Yeah, and I think, we're in a position now where things are changing day by day. I mean, we've recorded this podcast towards the end of the week. It goes out Sunday. There's every chance that in the next few days after this is released that things will change again. And Damien, I suppose what we'll do is we'll keep tabs on everything, and you'll do your usual research and insight. And we might touch on this again in a few weeks' time on a podcast as a separate piece, just to update people on what's going on.
Yeah, and I suppose the worst thing that could happen, but also the best, is before this podcast goes out, Trump decides to delay all the tariffs and everything's great, which would make this podcast slightly redundant. But let's fingers crossed that we do that. Before we go, actually, I will mention something else that happened. Is days before the stock market crashed, I sent out a newsletter to 80/20 investor members, and you can find this on social media. You can go and read the actual newsletter, which stated that this particular stock market indicator was flashing red as a warning sign that we're going to get a market collapse. So I feel particularly clever about that at the moment. I mean, I'm too modest most of the time. I think you've got to sing when you're winning. So that was interesting nonetheless. And if you want to know what that indicator was, then you can go and find it on our social channels, because there is a couple of posts about it and you can read that actual newsletter yourself.
So there we go. That is the podcast that we recorded literally minutes before Trump announced the pause on those trade tariffs. So we don't have a crystal ball, obviously, but there is a lot of value in that. And in hindsight, it was great that we were able to put that to listeners and record this last bit at the end of the podcast to give a little bit more insight after the fact.
Yeah, and what's important, I write a newsletter for 80/20 investor members. And one of the things that it does enable me to do is go back to a given moment in time and see what I thought and what my views and what the world was doing. So you don't have hindsight bias. And that is actually what this podcast episode has enabled us to do. So what's happened since that podcast was recorded? Donald Trump announced a pause on some of those tariffs, but has since escalated the tariffs with China. Now, the reason he did that was because of the bond market. So I mentioned the bond market. It wasn't getting a lot of attention in the mainstream media, but the bond market is what caused Donald Trump to capitulate, because as bond yields started to accelerate higher, and it seems like it was a hedge fund that was not just in the US, but possibly also in Japan, they were unwinding the basis trade that I mentioned in the podcast episode, that caused yields to keep pushing higher. And there is, of course, some speculation as to whether Japan and China are dumping some of their US treasuries as well. That caused the strain in financial markets to escalate to such a point that the 10-year US Treasury yield burst to 4.5%. So it rose even higher. And there was concern we were going to get a full-blown financial crisis. Now, the move by Donald Trump has caused some calm to return to markets, but the 10-year US Treasury yield, as I make this podcast, is back up at levels where it was just before he made the announcement that he was going to pause the tariffs. So we're back above 4.4%. So if you're going to do one thing, watch the 10-year US Treasury yield, because bond markets in the US are showing signs of stress. Now, we also saw the S&P 500 rally more than 9% in a single day, but we then saw it capitulate the next day and fall about 5%. So where we are still a long way down on the point of when the tariffs were first announced, which was obviously on Liberation Day, as Donald Trump calls it, and yields are much higher as well on bonds. So that is a strained situation, which is putting the Fed in a difficult position, as I mentioned in the podcast episode. So we aren't saved, nothing's changed. And if anything, what markets are now showing is they don't trust what Donald Trump is doing, and when they don't actually trust that he's not going to suddenly put tariffs back on, because he is actually increasing them on China. So much of what we talked about in that podcast is still true, and we are still concerned about what's going to happen in the future, and you still need to prepare for your own finances. But Andy, it was just a great example about how making knee-jerk reactions based upon headlines or speculation or what Donald Trump is doing, ultimately you're going to probably be on the wrong side of them, unless, as there is lots of speculation out there, there are people with inside knowledge making a lot of money out of these extreme market moves.
So that's 2 podcasts in 2 weeks where we've kind of shaken it up a little bit and done something a little bit different. Last week was deliberate, this week not so deliberate. So I suppose it's left for us to record a new outro, because we have already done that, but we've dumped that one from the first podcast. So let's just go again. Thanks ever so much for listening to the podcast. We are at the end now. Do all the usual things you do to help support Money to the Masses and what we do. If there's one thing that you did today, we'd love you to do is go and look at the description in this podcast. Look at all of those social links that we've got in there, and go and follow and subscribe and like the things that we do, because that is really going to help us in 2025 grow Money to the Masses and reach more people.
Yeah, and when we are in such a fast moving environment, a story like we've got here with the trade war, there's a lot of content that I push out on those channels that don't make it to the podcast, which are much more timely. So if you are interested in topics like this, then do make sure you follow us on our social channels. So Andy, that means that all that's left for us to do is finally to say until next time.
Until next time, unless we record it again and then it's until that time. Anyway, bye.